we shall be exploring the idea of depreciation and how it is recorded in the accounts. So let's start by trying to get an idea of what depreciation is about. When we buy office supplies, we debit an account for inventory. As the supplies are used, so we reduce the figure for inventory by a credit until the supplies are used and it is time to purchase some more. This idea is fairly easy to follow. We are buying assets, they get used, we no longer have the asset. The asset has been used in the running of the business. When it comes to some other assets, the picture is not as clear. Suppose that we purchase a delivery van for use in the business. We record a debit for the van in an asset account. The van is used during the year, but physically it is still there in its entirety, we hope, at the end of the year. It will be there physically until such time as it is sold or disposed of for scrap. The time period between purchase and disposal is referred to as the useful life of the asset. Initially, the purchase is recorded as an asset. The amount debited to the account is referred to as the historical cost. So, let's say we start with a pickup that cost $56,000 and that cash was paid. The original journal entry will have identified the two effects of the transaction, the transfer of assets, a decrease in cash and an increase in the asset of vehicles. The debit and credit will have been posted to the vehicle and cash accounts respectively. The measure we are trying to determine relates to the part that the asset plays in producing revenue during its useful life. Accountants would say that depreciation matches this cost to the useful life of the asset. So just as using office supplies becomes a cost of running the business, so the idea of depreciation can also be thought of as a cost of using the asset during its useful life. Whilst it would be nice if everyone agreed that there is only one way of doing this, that just is not the case. In part, this relates to the way an asset can lose value over time. Try looking at it this way. You buy a vehicle or a bicycle and you expect to use it to get to work over several years. Its use in getting to work is just the same after 2 or 3 years as it was in the first year. Now try and apply that to your new computer. In 2 to 3 years, will it be as useful as it is today? Probably not, because communication technology advances rapidly and many of the features you will be using in the future are still being developed. So what we're getting at here is that some assets provide more use in their early years. Put another way, they contribute more towards producing revenue in the early years. Assets that are used in this way need a form of depreciation that recognises this difference and reflects the way in which they contribute to revenues. The first method we shall look at takes the same view as the bicycle we mentioned. We assume the use is the same for all of its useful life. The method chosen to record this type of depreciation is called straight-line depreciation. We start by asking 2 questions about our asset. The first is how long will it be used by the business? In other words, what is its useful life? The second is to ask whether it will be worth anything at the end of its useful life. Will it be sold as a pre-owned piece of equipment or will it just be sold off for scrap? A third possibility is that it could be disposed of with no further value. We shall make a number of assumptions about Walter's pickup. We are going to assume that it will have a useful life of 6 years. We are going to assume that he will be able to sell it at the end of that time for $8,000. We now perform our first very simple calculation. We subtract the salvage amount from the historical cost to get the figure that we will depreciate. So, calculators at the ready, well that actually means your brain. The amount to depreciate is $56,000 less $8,000. That's right, the answer you have is $48,000. Now the second calculation. The useful life is 6 years or 72 months. So, calculators at the ready again. We divide the amount to depreciate by the useful life. $48,000 divided by 6, we get an answer of $8,000. This is the amount we would depreciate each year. Alternatively, we could work it out as a monthly figure. 48,000 divided by 72 gives us $667 per month. I've rounded up to the nearest dollar here. A business should depreciate at least once per year, since the figures form a part of the calculations for producing financial statements. If we did not record depreciation, we should be overstating our assets and understating our expenses. If a company has assets that have a high value, then it will probably choose to depreciate on a monthly basis. Now that we have determined the amount of depreciation, we need to make the entry to the accounts. We start by preparing the journal entry. We will need two accounts. One of these will be an expense account that records the amount of depreciation as an expense. The second is an asset account. While assets usually have a natural balance that is a debit, this one is a little different. The natural balance will be a credit. It is referred to as an accumulated depreciation account. This type of account, where the balance is contrary to the usual natural balance, is called a contra account. The account records the depreciation that has occurred since the asset was acquired. Assume we are making an entry for the month. We debit the expense account with $667. We credit the accumulated depreciation account with $667. The second method of recording depreciation is to use a method which is referred to as the double declining balance method. In simple mathematical terms, the rate of depreciation is twice the straight line method and is applied to the new book value each year. Okay, maybe it doesn't sound that simple, so let's look at it more closely. If we return to Walter's pickup, he depreciated the pickup over 6 years. So divide 100% by 6 and we get a rate of 16.66%. So next, double this. That's 33.33%, or a third for those of us who like fractions. Now we still need some other information from our first computations. The historical cost was $56,000 and the salvage figure was $8,000. The figure we are interested in is the historical cost. The depreciation in year 1 will be 33.33% of $56,000, or 1/3 of $56,000. You can do that in your heads. That works out as $18,666. This is the figure that will be entered to the accounts as the depreciation expense and accumulated depreciation at the end of the year. The book value of the pickup is the historical cost less the accumulated depreciation. So after year 1 it will be $56,000 less $18,666. That's $37,334. Now consider the second year. Depreciation is 33.33%, or 1/3 of $37,334. That is $12,445. The new book value is $37,334 less $12,445. That's $24,889. One point to remember when this method is used is that the figure for the book value cannot fall below the salvage value. A third method for determining depreciation is called the sum of the year digits. That also might sound a little strange, but this method is really quite easy to follow. The pickup has a useful life of 6 years, so the digits are 6, 5, 4, 3, 2 and 1. Add all these up, we get 21. Oh, and that rhymes. Now we go back and use the depreciable cost, which is $56,000 less $8,000. That's $48,000. So in year 1, we depreciate 6/21 of the cost. So 48,000 multiplied by 6, then divide the result by 21. I'm sure you can do that in your heads. Of course. 13,714. Here you can see a chart of the depreciation for each year. Remember that in this method we are always using the original figure for the depreciable cost and dividing by 21. Remember that the book value was based on historical cost less accumulated depreciation. So, on this method, the book value is the historical cost less the accumulated depreciation. So, 56,000 less 13,714. Note, the historical cost figure is $56,000. We did not use the depreciable cost figure for this calculation. If you look at this table, you will see that the book value reduces each year until it reaches the salvage value in the final year. A less common method of depreciation is the modified accelerated cost recovery scheme. There's a mouthful. In short, this is known as MACRS, and the scheme can only be applied to assets purchased since 1986, which is probably most assets these days. The IRS classifies assets according to their assessment of useful life. The IRS then sets depreciation rates for each year of the asset's life. Where it is used, the depreciation is usually determined either from tables or by using computer software packages. This ends our session on depreciation. Thank you for watching and for listening.